I want to go over a couple of potential trades in corn with you today. There's a seasonal buy coming up, I believe on the 15th. If you wanted to, if you traded seasonal futures, but I wanted to talk about a trade that I like to do when I'm trading futures. Actually, I'm going to give you two choices based on that seasonal buy coming up. First of all, let's look at corn. We've got it right in the middle of our Bollinger Bands. We look like we had a downtrend, some consolidation, a little bit of an uptrend right through here. We've got a weekly trend line here and a weekly trend line here. It's important to notice where that support is. It's at 376 and moving up, and then it's around 361 and moving up into 363. Take a look at the wave chart. Got the same thing. It's dropped back into the wave. The only thing that concerns me a little is we've got a little bit of a turn down here right on the wave. So something we have to keep an eye on. We could get the a turn down and head back up, and that's not a problem. But this is technically a buy zone. Now, if I was going to buy it outright, I would wait for a better candle than this. But the trades I want to talk about today really doesn't matter as long as you can get in at the right positions and have good support. These are moving averages. You can see we've got the 50 here. The 200 is actually right here, so it's acting as resistance. We got the 50, and then the EMAs are actually stacked pretty good for us. So let's talk a little bit about what type of trades we could place here. There's two things I would look to do. One, since we do have a seasonal buy coming up, I would look at trying to sell a naked put somewhere between 370 and 360. Gives you support here, gives you support at the 50, gives you a trend line right here. Let's take a look going back to the wave chart. You are at the bottom of the wave, but you would have a Keltner channel support right here following this trend line. Let's take a look at what say a 360 or a 355 or naked put would look like. Going out to the March 20, which actually expires, I believe, around the middle of February the 21st, I believe. Take a look and see what we've got. If we go to the 360, we can sell it for $1.37, which this is a 50-cent contract, so it'd actually be half of this would be what you'd actually get. So if you wanted to keep this in easier terms, you'd have to sell two of these, which would be $137 if you're trying to sell it right here. Take a look at what that would look like, analyze a sell trade. If we wanted to sell the 360 to $1.75, we're going to do two of them. Take a look at the risk profile. I'm going to change the date to the expiration, which is actually February the 21st. And you can see that we've got a 85% chance that this will finish out of the money for us. So we would just get to keep the whole credit. And again, on two contracts, that is about $137. And just to get an idea of what your margin would be, you're looking at about a $1,300 margin on that. But there's something else you could do to give you a little more protection. And what I'm looking at from here is if I was trading that seasonal buy, which I could even go up to the 365 and get a better credit based on that seasonal buy, but I'm not going to. So let's take a look at another way you could adjust this trade or turn it into a different type of trade. So what I'm going to want to do is I want to go back to the trades here, and I've already sold the 360 right here. I'm going to change that to the 355, which is a delta 9. Change that to a 355, gives me a little more protection on the downside. But what I'm going to do is I'm going to make this into a strangle, and I'm going to do that by selling this 425 call. Now I'm going to want to get about $1 out of it, and you could do that on either side. Looks like we've got a little better chance maybe of getting the put based on what it currently looks like. So I want to get $2 out of this. So I would go to do this strangle at $2. And let's look at what the risk profile is going to look like on this. So you can see now we've got an 84% probability of success. Our break even to the downside is now moved all the way down to 353.50, and it's up at 428 if we sell this for $2. So that would bring $200 into our account for basically the exact same risk. So we've doubled our potential return with the same risk. And let's look back at the chart itself so you can see where your break-evens are, 353.50 and 428. So 428 means our first break even is right in this area, 428.50. So you can see we got a lot of room to the upside. And then the downside, we're at about a 353. So we've got, all the way almost down to this low here, and up the top side, we've got a bunch of room above this high right here. And that's the way I would sell this. In fact, I did put a strangle sell in my real account, so I've already actually placed this trade. Traded it in for $2, and so I'm running this one right now. I'm going to try to sell it for about half. So I'm sorry, buy it back for about half. So I sold it for $2. I put in a good to cancel order for $1. So I try to get about half of it, and I'm just going to let it run. Looking at the charts, I think that it could really go either direction. However, the seasonal is to buy right here. Some people like to trade seasonal, some don't. I do probability trades, so I would much rather say if the seasonal is to buy, then I'll just sell a put down here somewhere. That way I've got some protection in case the seasonal doesn't work out. So I recommend doing a strangle in corn. And again, let's go back. I'll show you the trade. We're going to sell the 355 put that expires. It's the March 20, which expires on February the 21st. We're going to sell the 355 put and the 425 call. We need to get about $2 in the strangle and set a good to close at about $1 of that, or whatever you're comfortable with. If you like this trade, let me know. If you have any questions or comments, let me know that also. And please subscribe to the channel. Thanks.